us started here and just let them in as they come. So thanks for all coming. Today we'll be having a presentation from Rockstone Research and Stephan Bogner. Stephan is a mining and commodity analyst with Rockstone Research, which is a research house specialized in analysis of capital markets and publicly listed companies. So Stephan, I'll hand it all to you. Now I'm going to mute everybody here, but like I said, if you have any questions, just go ahead and ask after the individual company presentations, or you can also message in the chat box and we'll be sure to get to you. All right, Stephan, take it away. Oh, sorry, Stephan, you are just muted if you want to just.
Okay, yeah, thanks for setting this up, Colton, and the entire Zimtu team. Hello, everybody. Good morning, Vancouver. Good afternoon, Toronto, and guten Abend nach Europa. So let's get started. Let's not waste any time. The markets are open. We want to keep everything to the point here and stay casual. So I have some fantastic guests here for this show today, executives from exploration companies, most of which I'm actually a shareholder of. So obviously I'm biased. However, I really think that these companies are on the verge of creating shareholder value, especially if and when the gold price gets moving again. And today we have Sophie Caesar from X-Men Mining, we have David Gower from Emerita Resources, Pet Power, and James Ferreira from Lakewind Resources, Dave McMillan and Chris Nash from IMC International Mining, and Scott Rose from Core Assets. So yeah, before we get talking to these executives, I will briefly take a look at the gold market and present you some reasons why are we actually doing this show here today. And it's because I believe that the correction in the gold price and on also other commodities, that since gold corrected in August, I believe it's at the very end right now, and that a new price upswing is ahead of us. And yeah, this could be a really great opportunity for investors. And I'm going to show you my presentation here right now. So let's get started. Yeah, I will show you some charts which I found. I really like Twitter for that, as I'm following more than 3,000 people and companies there. So check out those charts I have here and those people I mentioned here, as I think they are among the best analysts and they do really good. Here we can see the gold price since 2018, and actually it has been really a roller coaster since over the last weeks and months. And we can see that the gold uptrend, it started in mid 2018, and actually since then we are in a really nice upward trend. Of course, Corona crisis in March here, it also had an impact, but I believe that the coronavirus is not really the main driver of this gold bull. And especially if this pandemic gets resolved with vaccines or whatever, I don't think this gold bull market is going to end. We can see that the gold price spiked very dramatically in mid this year, and after that the gold price corrected, and it took since August like a couple of months now already, and we just recently we hit the 200-day daily moving average, which is a very strong support, and I believe we from this point on we will go higher. Here we can see the gold price in gold in the 70s. When it was rising for about 5 years, and then it also consolidated for a couple of years before it then really took off in a final leg. And if we then now superimpose the gold price since the 1999, we can see a similar pattern, although the time frame is a bit longer than the 10 years in the 70s. So here we see in black the gold price, it also went up just like in the 70s to this point here, and then a consolidation, a correction started, which took since 2011, it took now almost 10 years, and since 2018 we are actually in an upswing again. And as you can see here in the 70s, we also had a big correction, and this was because we were going over this green resistance. This was the high of the mid 70s. So once we broke over this high in the 70s, there was a pullback. And this is what typically happens to prices. Once you break above a resistance, there's a breakout, and after that there's a correction and a pullback. just to confirm this resistance as new support. And we have been seeing the same here with the gold price in black. Actually, it's a bit older, this chart. So we have been seeing that we have a new all-time high. We went over it, and then that there was a correction. So I think now with this support level, we are in the final legs of a gold bull market. And I think right now it's actually the best time to be invested. Here's another picture of the US dollar gold price, where you can see the 2011-2012 all-time high of about 1923. And this resistance here, the green line, we broke out over this resistance here in 2020. And what happened after that is it was a correction, pretty harsh correction, but it's all healthy because we are just confirming this resistance as new support. And once it has been confirmed as support, the new upward trend actually starts. And we can see it down here. Here's the mining index of the Hui, and it's already going up. And the US dollar, it's also very important to always follow the US dollar because the gold price, it follows the fluctuations of the US dollar. Now here we can see the log scale of the gold price in the 70s, when in the mid 70s it rose very sharply to this level here. And the same dimension is happening since 2000 until 2011. And as you can see in the 70s, this resistance here, after we hit this resistance here, there was a sideways consolidation and a correction going on until this point here, when this resistance was broken and a breakout took place, and thereafter a correction, a pullback happened. And after this pullback, it was confirming this former resistance, then an upward trend started. And now we are seeing the same again. After we hit this resistance here, we had in 2011, we had a correction going on. And now we have hit the all-time high. We went over it. We have been confirming this former resistance. And now the way is open for a new bull market. And according to this, if we take the same dimension here as in the 70s and in 2000s, we are likely going towards 10,000 US dollars. And that's like the best time to be invested in mining stocks. And also a gold price and other currencies. Here we see the top 20 currency ranked by GDP. We are a bit further. The US dollar gold price is actually lacking behind other currencies, the euro, the Canadian gold price, Australian gold price. They are much further advanced, and we are much higher than the previous high in the 2011 and 20. But also here you can see that we just hit a very strong support, and that from this support level, the gold price could go higher. Yeah, if we look at the last gold bull market from 2000 to 2011, 12, we also had a high number of corrections taking place with 20%, 28%. So in August, we hit 2,089 US dollars, and then we saw a correction to 1760 about, so that's minus 15%. And so, yeah, it's a normal correction that's happening. It's nothing unusual, it's healthy, and that's what we actually want. We want a high volatility in the gold price because this shows us that the market is alive, and we want high volatility. Also, it can be brutal if you are not really long-term oriented with your investments, but I think that these corrections, they also offer great opportunities. So here we can see the US dollar. The US dollar is very important to follow over the next years, of course, especially for the US dollar gold price. We can see that the support level of the US dollar index here at 92 points, it has been broken to the downside. And this is really a negative sign for the US dollar, and it should go lower. Here we can see a long-term chart of the US dollar since the 80s. And here we can also see that the next really bigger support level is in the 85 region. And we can see that asset managers worldwide, they are shorting the gold, the US dollar index and the US dollar, and never before since 2011 the shorts were so high as right now. So I'm also betting that the US dollar will go down over the next months and weeks, because all the liquidity that is being pumped into all kinds of markets, it's actually not good for the US dollar. And also we can see a lot of negative yielding debts and bonds, and this is also driving the gold price, that people are looking for alternatives, and with negative interest rates, people are really looking for ways to protect themselves. Here we can see the debt as a percentage of GDP since the 1940s, and that we are actually now surpassing the World War II levels. And this is really dramatic what's happening here, because I don't really see there a point of that debt going back again. In the 70s, we also had debt going up, and we had inflation. But the good thing in the 70s was that the debts were not so high as they are right now. And back then, when we had the inflation, you could combat and fight the inflation with higher interest rates. And that's what Paul Volcker did in the 1970s, end of the 70s, in the 80s. He raised the interest rates to almost 15%, and that killed the inflation. And then the bull market in gold was also over. The problem today is we have so much debt that they cannot really raise the interest rates. So once we are really going to see inflation picking up, there's no way to stop it with higher interest rates. So that's really going to fuel the gold market, because once inflation is really coming up, it's going to be problematic to stop it. Here we can see that the money growth, the M1, M2, and M3, and how they have been increasing over the last weeks and months, and over the years, of course, but that since the Corona crisis in early 2020, they have added so much money, and actually since September 2019, over $9 trillion, and they're saying that 22% of all US dollars were created in 2020. Here in red, we can see the M1 money growth and the gold price here in gold, and that actually the gold price is following the M1 money printing, and that the gold price actually, once in the beginning of a bull market, it really is very close to the M1 money amount. And then at the later stage of the bull market, the gold price really takes off and trades much higher than the M1. And we can see that here right now the gold price is very close again, and that we are probably in the beginning of a new bull market, and the gold price should really shoot up much higher. And yeah, it's unprecedented. We have never seen anything like this before. You can see here the M1, how much trillions of dollars have been created and how fast it is going on. And this really shows to me that we are at the very end of this fiat experiment of money printing. It's really going exponential right now. And even the central banks, they want higher inflation, and I see higher inflation coming up. Everybody wants it. Inflation is needed, and central banks are doing everything they can to do it. Of course, we have a deflation right now, deflationary pressures. However, you probably know that that deflation is the prerequisite of inflation. So before really a great inflation kicks in, there must be deflationary pressures before that. And that's what we are seeing right now. We are seeing deflationary pressures everywhere. The US dollar is still pretty strong, but over the long term, I see inflation picking up. And here we can see the currency creation compared to gold and silver. Here we see 120 billion US dollar being printed every month, and in the US, and gold monthly production worldwide is only 13.6 billion. So they are printing 10 times as much money as gold is being mined and being put into this market. And this really shows how tiny the gold market is. And yeah, Ludwig van Mises, he once said that there's no means of avoiding the final collapse of a boom brought by credit expansion. and the alternative is either you abandon the credit expansion, or you wait for the final catastrophe to happen. And yeah, he's right that there's no means of avoiding this final collapse of currencies, debasements, but there is a means of protecting yourself. And I believe that physical precious metals and of course gold mining stocks, they are the way to protect yourself. And when we look at the wealth distribution in the US alone, we can see that about 69 trillion US dollars is in financial wealth. That's paper money wealth, that's stock markets, paper, and all these papers, of course, they can depreciate very low because they don't have intrinsic value like gold and silver. And that real wealth, that's businesses and real estate, there's $36 trillion. And that actually only less than $1 trillion in the US is actually in gold and silver. And just imagine if just 1 trillion of all these hundreds trillion in the US comes into the gold market, and the gold market really cannot absorb this kind of money which is flowing around worldwide. And that's really the beauty of the gold market, is that it's really so tiny. And in next years, we're going to see that people are going to protect their money, especially during inflation. So all these monetary values, which are in financials and paper money, but also in real estate, they are trying to protect themselves. And if one of those $356 trillion worldwide is flowing into the gold market, the gold price is really going to explode. Now let's look at the non-financial businesses, like companies on the stock market in the US and UK. We can see that the debts also, they have increased very sharply over the last years, but that the profits of the companies, they have not really picked up. And that's really a bad sign, that when you create or take all those debts, that you're not really turning this money into profits. And that's not a really healthy sign for the stock markets, in my opinion. And here you can see the commodities as a ratio to the equities, that we are right now at a very low point, and that commodities are very cheap compared to stock market valuations, and that this is like a great buying opportunity for commodities, and that over the next years and decades, I believe we are really going higher. Here we can see commodities since the end of the 1870s, and that actually in 1930s the commodity prices started to rise, and since the 1930s the commodity prices are in an upswing. Typically for the prices, they rise very sharply over maybe 10 years, 20 years, and then they do a sideways consolidation, and this is what has been happening over the last decades. And right now we are down here, and it's a great support level. And I think that over the next decade, we are going to see much higher commodity prices. Below here, you can see in yellow the inflation rate, and you can see also that the uppicking inflation, that's what commodities are performing the best during higher inflation. And right now inflation is also at the bottom. So I think that from here on, inflation will pick up and commodities will also start rising. Here we can see an interesting chart from a guy from Twitter, Grady. It's a couple months old, actually, before the bull market started. It was here in, I think it was mid or early 2020s. So right now we are here at this level here at 2000 about. But this really shows that since the 70s in a logarithmic scale, we are really here in a new upward trend, and this should take the gold prices really higher. And he also sees that over until 2030s, 2040, gold price will be rather in the area of $10,000. Now, here you, in the past and still today, many people and analysts, they are talking about the gold price bubble of the 70s and even in the 20s, in the 2000s. And in the 70s, gold price rose 20-fold to an intraday high of a bit more than 850. But here you can see the annual average prices of oil in black and gold in orange. So it doesn't really include the daily peaks and lows, only the long-term annual average price. So in the 70s, the oil price, it rose from $1.80 per barrel to $36. So what this chart shows us that if the oil price goes up, so does the production cost of gold, because mining is primarily very energy intensive and oil still is the major cost driver. So if the production costs go up, so does the gold price. So the first gold bull market in the 70s, it was not a bubble. It was driven by higher oil prices or oil price inflation. And in the 80s and 90s, then the oil price corrected, and so did the gold price. And then in 2000, oil was about $14 a barrel. And then within 10, 12 years, it shot up to about 110, where it stayed for almost about 3 years. And as you can see now here is that gold followed the higher oil prices because if the price to produce gold goes up, so does the market price. So both bull markets we saw in gold in the 70s and then 2000s, they were not really bubbles, but they were driven by higher oil price. And then a couple of years ago, the oil price corrected sharply all the way to this day, and so did gold. But now, this third gold bull market we are currently in, you can see a disconnect from oil, and this is really very powerful because gold price right now is not driven by higher production costs and oil price inflation, but by a massive increase of investment demand. And gold is now, for the first time actually ever, is behaving not like a commodity as it did in the last two bull markets, but as a currency and a store of value or as an investment. And this is the most strongest fundamentals for a gold bull market. And especially as Steve Angelo, he also said from SRS Rocco report that he said, I don't see this gold bull market ending. And certainly the gold price will continue to fluctuate and we will see sharp corrections like we have seen in the past couple of months. And but the demand will only get stronger as the world will begin to transition from building wealth to a new paradigm of protecting wealth with precious metals. So here we can see the full production costs of the two largest gold producers in the world, that's Barrick and Newmont in orange, and the gold price in green. And you see that between 2000 and 2008, the gold price was almost the same as the production costs. And then in 2008, the global financial crisis started and people were getting really worried. So we saw the gold price increase a bit higher than the production costs, especially in 2011 and 2012. So during this time, gold was performing more like a monetary metal and not as a commodity as it did in the years before. So then we saw the correction in gold in 2012, but it was not that the bubble burst or but it was because that the gold price went back to the production costs. And this was a very strong support level. And that's why also the gold price didn't really go much below these production costs, because that's really a support level. So now we are already seeing the gold price going much higher than the production costs, which is a very healthy sign for a strong new bull market in gold, because now gold is finally acting as a monetary metal and not as a commodity as in the past. And this third bull market we are currently in, and I believe it will be the strongest ever, as I believe just because of these fundamentals that the price is driven by investment demand, which was not really the case during the last two bull markets. And yeah, this now will be very good for gold exploration and mining companies, especially also for investors, because these companies now can make much more money mining gold, but also the incentives to find new gold resources, it's much bigger right now. So more money will flow into the exploration space. So here we can see actually on the top, you can see the gold discoveries over the last decades in yellow here, in millions of ounces. And you can see that we have a a downtrend. We are not really discovering more gold ounces. And this is quite fascinating because here you can see in red on the right the gold price. And you know, in the 2000s, all the way until 2011 and 2012, we had much higher gold prices. But this, despite of increased exploration spendings and budgets, which you can see down here in red. When the gold price was picking up, that's normal that the companies, the mining companies, but also the exploration companies, they increase the exploration budgets because the gold price is higher, the incentives are there. But despite these much increased exploration budgets, we did not find any more or much gold, and this is really dramatic, and why people are talking about peak gold right now, we can see here, but only until 2013. And I also believe that we have seen peak gold already over the last years. Over the next years, we will see the gold production globally going down. And yeah, I mean, this is the perfect scenario for exploration companies. I mean, of course, it's more difficult to find, as we can see here on these charts. It's difficult to find gold, but if you find gold, and if there's a small company finding gold and building these resources, then you're really against this trend, and this is really valuable. And that's why I think exploration over the next years, it will be the key sector where people can make money if those companies really can build on resources, discover gold resources, and yeah, once they have discovered it, the big mining companies, they are not really into exploration business. That's not what they do. They do mining, they do the production. They have cut all the exploration spendings over the last year just because they have seen that it doesn't really make sense to spend money because they're not finding anything. So let's put that risk to the exploration companies. And once they have found something, we can see that these companies will they will be picked up by the seniors. They will be acquired. I think the M&A and acquisitions in the mining sector will increase over the next months and years, and that's the perfect scenario for explorers. So that was my presentation here right now.